Global Market Outlook. Are we there yet? Equities and bonds faced a challenging April as the Fed continued to guide rate hike expectations higher. However, as global central banks embark on policy tightening, the main question facing investors is whether we are approaching the bottom in risky assets. Our still benign recession checklist gives us confidence that equities can outperform bonds and cash once the Fed stops guiding rate expectations higher. We continue to prefer Asia ex-Japan equities, even if COVID-19 lockdowns in China delay the recovery. Bond yields could rise further before topping out. We favor EM-USD government, Asia-USD, and US-European high-yield bonds where attractive valuations are a support. Private credit and floating rate loans also offer an attractive risk-reward. We maintain our preference for commodity currencies. Investment strategy and key themes. The Fed guides rate expectations higher and markets lower. While April is usually a positive month for equities from a seasonality perspective, 2022 is proving to be different. Since the end of March, global equities have fallen over 6%, with Chinese equities falling about 9%. In the US, the Fed's efforts to guide rate hike expectations higher was one driver, leaving the 10-year US government bond yield almost 50 BPS higher, the USD about 5% higher, and gold slightly lower over the past month. On the back of a hawkish Fed guidance amid rising inflation expectations, we revise our own views and now expect the Fed funds rate at 2.25% and the 10-year US government bond yield in the 2.5% to 2.75% range by the end of 2022. Are equities close to a bottom with a fairly aggressive Fed hiking cycle already priced in? The next Fed meeting in early May is likely to see a 50 BPS rate hike and the start of quantitative tightening. Given this and our view that growth and inflation are likely to slow in H2, we are likely approaching the point where the Fed limits how much higher it guides policy expectations. Markets already expect policy rates to reach the Fed's estimated neutral level by year-end, and the majority of indicators on our recession checklist remain at healthy levels. This constructive outlook could change if the Fed feels a need to push the economy into recession to contain inflation expectations. But at this time, we believe that is unlikely if growth and inflation slow in H2 as we expect. China's COVID-19 policies and any wide-ranging European embargoes on Russian oil and gas are risks to global growth and inflation should they create new supply shocks. Should I start buying bonds? It is logical to ask whether today's bond yields offer an opportunity for long-term investors to accumulate bonds. As we noted last month, we would argue it does, but very selectively where risk-reward is justified by a range of drivers. EM-USD government bonds are one example of where we do see an increasingly attractive opportunity, given credit spreads have also weakened significantly. High-yield bonds are another, both in US-Europe, where credit quality is holding up, and in Asia, where valuations remain close to extremes. It is possible bonds start looking attractive more broadly at some point, especially if economic growth starts to slow towards or below trend. However, bond yields could go higher near term as central banks stay hawkish. Hence, we would wait for Fed guidance to assess whether the market repricing of rate hikes is done. This could possibly mean the 10-year US government bond yield rises modestly above 3% first. Taking advantage of volatility. One outcome of the rapid repricing of Fed rate expectations over the past month has been an extended period of volatility, not only in equities, but also in bond and currency markets. For currencies, the continued rise in yields has meant the USD rally has extended for longer than we expected. Having said that, we continue to believe that once US rate hike expectations are fully priced in and expectations start to catch up elsewhere, the USD is likely to reverse. To take advantage of the volatility, we continue to prefer the AUD, CAD, and NZD, where rate hikes by the respective central banks offer a good hedge against the risk the Fed rate hike repricing is not yet complete. In equities, we also believe the relatively high volatility offers several opportunities. From a 6 to 12-month perspective, we continue to expect equities to outperform bonds and cash, especially with elevated inflation supporting nominal earnings. A US recession is likely to be the main risk to this view, but as our recession checklist from last month demonstrates, most indicators are not flashing a warning sign as yet. We would also note that with the current market expectation of Fed rate hikes, policy rates would only approach the Fed's estimated neutral level by year-end. This means worries of a tight Fed policy should be more of a concern for 2023 or later, not this year. What about China? The economic shock from the continued lockdown is proving to be a dominating factor for Chinese equities, bonds, and currency markets. Given the widespread restrictions on economic activity, it is possible the market weakness extends until the most acute phase of the lockdowns is over. This makes timing a bottom in Chinese equities very difficult. Having said that, we believe the four factors we outlined in recent months behind our positive 6 to 12-month view on Asia ex-Japan equities remain valid. Supportive China policies, the pessimistic outlook already priced in, Asia ex-China's gradual emergence from COVID-19, and several Asian markets' correlation to a global recovery. Chinese policy support for the economy remains a key assumption, but we are likely to see greater fiscal support once lockdowns are eased, given this, when the impact on demand is likely to be greater. Closing bond yield differentials between US and Chinese government bonds could place further downward pressure on the CNH in the short term. However, this is likely to fade if the USD does peak as we expect. Perspectives on key client questions. Twin tightening, a double whammy for risk assets. The US Fed began its rate hiking cycle last month with a 25 BPS rate hike. Markets are now pricing a Fed rate of 2.75% by the end of the year. Meanwhile, the Fed's meeting minutes suggest quantitative tightening is likely to start in May. The Fed is expected to reduce the size of its bond holdings eventually by USD 95 billion a month, marking the second time it will hike rates and reduce its balance sheet concurrently. This would make it one of its most aggressive policy tightening cycles in recent decades. Against this backdrop, the volatility of major asset classes has spiked. Bond volatility approached 2020 recession highs, while equity volatility hit levels above the end 2018 levels when the Fed last undertook twin tightening. We look to the prior episode of twin policy tightening to see which asset class did well or poorly when both policy tools were tightened together, and how investors might prepare their investments against this backdrop. Faster pace of tightening today, but level not necessarily tighter. The Fed is expected to start contracting its balance sheet in May after delivering the first interest rate hike in March. While the pace of asset reduction is almost double that of 4 years ago, the underlying economic conditions are vastly different. Inflation and economic growth are much higher and labour markets much tighter today compared with 2017. The real 10-year government bond yields was 50 bps at the start of twin tightening in 2017, driving market volatility higher and triggering the 2018 repo crisis. Financial conditions are arguably looser today, despite a much tighter labour market and higher inflationary concerns. Therefore, it probably makes sense for the Fed to tighten more aggressively now to play catch-up. Poor returns on bonds during Fed tightening. Bonds delivered 0 to negative returns with elevated volatility when QT and higher rates occurred simultaneously in 2017 to 2018. While bonds were range-bound initially, they fell subsequently on renewed expectations of tighter monetary policy and higher real yields. Long maturity assets such as DM investment-grade government bonds sold off, while EM local currency bonds were also impacted by a stronger USD. The performance of bonds only started to improve once real and nominal yields peaked in November 2018, and the Fed turned decisively dovish in 2019. TIPS bonds were flat, and only China government bonds delivered positive returns in this period. Strategies for bond investors. Rising yields have been a challenge for fixed income assets over the past 2 years. Bonds remain least preferred, particularly DMIG sovereign and corporate bonds. We retain a neutral duration stance given upside risks to inflation. That said, higher rates tend to slow economic growth, and it is possible that bonds, particularly long tenure bonds, could start looking more attractive, especially if growth starts to slow going into next year. Hence, removing exposure to rate-sensitive assets entirely may also not be an optimal decision. At higher levels of bond yields, possibly when US 10-year government bond yields rises modestly above 3%, some exposure to higher quality bonds may be warranted to help mitigate risk late in the cycle. Investors can also consider Chinese government bonds, with authorities embarking on an easing cycle and to some extent US Treasury inflation-protected securities. However, if the Fed is successful in lowering inflation expectations, then regular bonds will likely outperform TIPS. Equities went up, then down in 2018. Equities did well in the initial part of twin policy tightening, but eventually performance started to diverge as volatility picked up on the back of growth concerns. Investors would have been better off overweighting risk assets in the early part of the twin tightening and reverting to a neutral underweight positioning by late 2018. Within equities, the US, Japan, and the commodity sector were the clear standouts, outpacing other key regions in the first 12 months of twin tightening. Ample liquidity this time. While it is unclear how much liquidity is considered as ample, the starting point of the Fed's balance sheet is much larger at USD 8.5 trillion. The rate of balance sheet tightening is expected to run at 0.12% per annum of the initial balance sheet size versus 0.13% in 2017. Bank reserves and other forms of money are also more plentiful this time. Should there be a liquidity squeeze due to QT, there are tools institutions can access via Fed's new standing repo facility or through existing swap lines with other central banks, which can help mitigate a liquidity fallout like that of late 2018. The flip side is this may well embolden the Fed to be more aggressive on its tightening plan than it otherwise would have been. Hence, we retain a less preferred stance on bonds. Strategies for equity investors. we continue to prefer equities and expect volatility to stay elevated. Lower real yields and global equities having already fallen C.11% YTD mark two key differences with the prior start of QT, suggesting a lot of tightening concerns may now be priced. A rise in the chances of a recession is a key risk. Hence, we would consider exposure to risk hedges such as gold or holding a greater cash buffer alongside as tightening becomes more advanced. Gold's performance was lackluster during 2017 to 2018, which is not entirely surprising as it tends to do poorly during periods of tightening. Given the war in Ukraine, though, gold and other commodity-based assets may potentially serve as good hedges this time, especially if a long-drawn conflict prolongs commodity shortages and supply chain disruptions. Our thematic ideas. A brief overview of our currently open thematic ideas coupled with some recent highlights. Key themes. Embracing a digital future. Our 5G, Internet of Things, and cybersecurity themes have performed well relative to global equities, despite recording negative returns since the start of 2022. The strong price performance for cybersecurity, especially since the Ukraine invasion, highlights the growing demand tailwind stemming from the war. We continue to prefer the cybersecurity theme amid strong earnings upgrades, which in turn supports its rich valuations. IoT valuations have fallen considerably and look attractive compared with global equities after accounting for their strong growth expectations. Government spending on digital infrastructure remains pivotal in sustaining the long-run sustainability of the theme. For instance, a breakdown of the Australian federal budget shows AUD 130.1 million will be spent over 2022 to 2025 as part of the digital economy strategy to drive digital transformation. Over the long term, the International Data Corporation expects spending on computer and storage infrastructure to deliver a compound annual growth rate of 12.6% between 2021 and 2026, reaching USD 133.7 billion. The investments channeled towards reshaping and sustaining a safe digital environment confirm the growing importance and longevity of this theme. Hence, we continue to see the potential for these themes to outperform the broader market over a long-term horizon of 3 to 5 years. The winds of climate change. Climate-related themes have fallen since last month's update. Most notably, electric vehicles are the worst hit, down C.22% since their peak in January. Precious metals used in EV batteries, such as lithium, nickel and aluminium, have seen a sizable uptick in prices since 2020. With demand for lithium-ion batteries surging, there are concerns that the EV sector could face challenges in terms of a looming supply shortage for batteries, especially with the ongoing Ukraine war and Russia being a major exporter of key materials. Earnings revisions are trending lower across the board. However, valuations have also dropped slightly since our last update. Although the energy transition narrative has been boosted by the recent push for energy security, the shift towards green energy further exacerbates metal shortages as clean technologies require significant amounts of metals and supply chain disruptions are likely to persist in the near term. However, renewable energy developers are adapting and learning to source from alternative suppliers. This supply constraint is also giving rise to concepts such as the circularity of materials used in renewable energy, including EV batteries. While this is a near-term headwind, we continue to view more positively on the future outlook for climate investing, given its importance in global mandates of combating climate change. China's common prosperity. China's common prosperity theme has been greatly challenged, with the hard tech manufacturing and green renewable themes down over 30% each since the start of 2022. China's Omicron wave and its zero COVID policy leading to lockdowns in Shanghai and other regions have weighed negatively on investor sentiment. However, the authorities are beginning to introduce measures to resume production and mitigate disruptions to industries affected by the lockdowns. Additionally, valuations for high-tech manufacturing and renewables continue to fall, i.e., they appear increasingly attractive against both the global and Chinese equity market. Nonetheless, China's commitment to net zero climate goals was reconfirmed in its recent announcements. According to the National Development and Reform Commission, China will add 140 gigawatts of capacity from clean energy resources, which is more than the rest of the world combined in 2020. We also see these efforts at utilizing renewable energy to meet energy demands as positive for domestic Chinese hard tech and semiconductors businesses, as the latter are key for China to adopt clean technology. Moreover, more than half of China's recent USD 2.3 trillion infrastructure plan will be directed to support the manufacturing and service industries. This emphasis also reflects China's commitment to ensuring its dominant share in global manufacturing, especially in areas such as EV, renewable energy, and microchips. Thus, we remain convinced that this investment theme has plenty of room to run in the coming years.